You know, there's this huge multi-trillion-dollar puzzle right at the heart of the global economy, and honestly, it trips up almost everyone. It's this one idea that just seems to defy all logic, but it quietly affects everything. From your retirement savings to the interest rate on your next car loan, today we're going to crack it wide open.
I mean, it sounds completely backwards, doesn't it? You hear that interest rates are going up, which seems like it should be good news, right? But then bam, the value of all these existing bonds suddenly drops. How on earth does that even work? Let's solve this thing once and for all. Okay, the absolute best way to think about this is to picture a seesaw. On one end, you've got a bond's price, and on the other end, you've got its yield, the return it pays out. And just like a real seesaw, when one side goes up, the other has to come down. It's a simple picture, but it's incredibly powerful for getting this relationship. But we're not talking about some little playground toy here. This is the global bond market we're dealing with. A massive, massive system that decides how governments build new bridges and how giant companies fund their next big project. So, understanding this seesaw is really the key to understanding how money moves around the entire world.
So, what even is a bond? Let's strip away all the jargon. At its core, it's just a loan. It's an IOU. You, the investor, are the lender, and a government or a big company is the borrower. They promise to pay you back your original money way down the road. And in the meantime, they pay you interest for the privilege of using your cash. Simple as that.
So to really get how this financial seesaw works, we've got to meet the players sitting on either end. Let's do a quick breakdown of the anatomy of a bond.
And here is the absolute key to the whole thing. Look at this table. The top two items, face value and coupon rate, they're set in stone. They're locked in the day the bond is created, and they never, ever change. But the bottom two, market price and current yield, whoa, they're alive. They are constantly moving, reacting to everything happening in the world. This is where all the action is.
First, let's just focus on that coupon. Think of this as the bond's unbreakable promise. So for example, if you have a 500,000 peso bond with a 6% coupon, it promises to pay you 30,000 pesos every single year, no matter what. That payment is a constant. It's a reliable anchor. You have to remember that fixed dollar amount.
Now, on the other hand, you've got the market price. This is the wild card. This is what someone would actually pay you for that bond today. And it almost never equals the original face value, because it has to constantly adjust to what's happening out there in the economy, especially what's happening with interest rates.
All right, now let's put these pieces together in a real-world showdown. This is where we get to see that seesaw really come to life.
Okay, imagine you own a bond that pays a 3% coupon. It's been great, reliably paying you $30 a year on your $1,000 investment. But then, all of a sudden, the whole market changes. Brand new bonds are now being sold that pay 5%. So which one would you rather buy? The new one, of course. It's just a way better deal, which means your old bond is now looking, well, kind of lame.
So if you decide you want to sell your old 3% bond, you've got a problem. Nobody is going to pay you the full $1,000 for it when they can just go buy a shiny new 5% bond for that same price. The only way to make your bond attractive again is to lower its price. Sell it at a discount. And right there, that's it. That's the aha moment. To compete with the new, higher rates, your old bond's price has to fall.
And this isn't some weird arbitrary rule. It's actually the market's incredibly elegant logic at work. The price is the one piece that can change, so it has to adjust to keep all these different investments competitive with each other. It's just this constant, beautiful balancing act.
So that drop in price has this really fascinating side effect. For the new person who buys your old bond at that discounted price, their actual return on their investment is now higher. And this effective return, that's what we call yield. And it is the absolute key to understanding a bond's real value in the market today.
And you know what? The math is actually super simple. We figure out the current yield by taking that fixed, unchanging annual coupon payment, and we divide it by the bond's current market price. This little formula is the engine that drives our entire seesaw.
Let's put some real numbers on this. Imagine a different bond, one with a fixed annual coupon payment of $50. Now remember, this number is our anchor. It is locked in. It is never, ever going to change.
Okay, now watch this. If interest rates in the market rise and the price of that bond falls to, say, $900, look what happens. The new owner still gets that same $50 a year, but because they only paid $900 for it, their effective return, their yield, is now 5.56%. The yield went up because the price went down. That is the seesaw right there in action.
Now, in the real world, the finance pros use a slightly more detailed calculation called yield to maturity, or YTM. It's a bit more complex because it accounts for all the future payments all the way to the end. But the core logic, it's absolutely identical. When the price goes down, the yield for any new buyer has to go up.
Okay, so let's zoom out. Why does any of this matter to you? Well, because the forces that move this seesaw are the same exact forces you hear about in the news every single day, and they have a direct impact on your financial life.
It all starts right here. When you hear that the Federal Reserve is hiking rates to fight inflation, they are literally pushing up one side of our seesaw. And that single decision ripples through the entire economy, changing the rate you get on your savings account and, maybe more importantly, the rate you pay on a mortgage.
And here's exactly how it plays out. As you can see right here in this table, a Fed rate hike or a jump in inflation, they both push yields up, which in turn forces existing bond prices down. But look at that last row. A fear of recession can actually flip the whole script. When times get scary, investors often rush into the safety of government bonds, which can push their prices up and their yields down.
Just think about it for a second. Your bond promises you a fixed number of dollars in the future. But if inflation is running high, those dollars are going to buy you less and less stuff each year. That's why they call inflation a bond's worst enemy. It just eats away at your real return, which is why investors have to demand higher yields to make up for that risk.
So, the big takeaway is this. The bond market seesaw isn't just some quirky, random rule of finance. It's this beautiful, logical, and totally necessary mechanism. It's how the market constantly and efficiently reprices the value of old promises in a world that's always changing.
So, the next time you hear that interest rates are on the move, you'll know exactly what's going on behind the scenes. The price, well, that tells you the value of the old promise. But the yield? The yield tells you what that promise is worth in the world right now. They're just two sides of the same coin, locked in this perpetual dance on the market seesaw. So, which one will you be watching?